All right, we're about to connect some dots that you might not think belong together. We're going from the very highest levels of global finance all the way down to a single content creator, a blogger, just trying to get by. It's a story about these hidden tremors in the systems we all depend on. And, it all kicks off with one absolutely massive number. $125 billion. Let that sink in for a second. That is how much cash the U.S. Federal Reserve quietly pushed into the banking system in just 5 days. Now, this wasn't some big stimulus package you heard about on the news. No, this was a quiet, behind-the-scenes maneuver, an emergency fix.
So, you gotta ask, right? Why? What on earth was going on inside the financial system that required such a huge and rapid infusion of cash? Well, as we're about to see, this was really just the first sign of a much bigger story. A story about stability, uncertainty, and ultimately, survival.
Okay, so let's start at the very top. The first thing you need to get is that this cash injection, it wasn't about juicing the economy or sending the stock market to the moon. This was about fixing a leak, a really big leak in the fundamental plumbing of the financial world. And to understand that plumbing, you need to know about bank reserves. The simplest way to think about it is like a bank's own checking account, but it's held at the central bank, the Fed. It's the safety cushion they use for everything, customer withdrawals, settling payments between banks. It's basically the lubricant that keeps the whole system running smoothly. And when that lubricant starts to run low, things can grind to a halt pretty fast. See, the problem wasn't just one number, it was the trend. Earlier in the year, that safety cushion was a pretty comfortable $3.3 trillion. But by late 2025, it had shrunk all the way down to $2.8 trillion, a 4-year low. When that buffer gets thin, the whole system gets brittle. And that is the kind of thing that makes people at the Fed really, really nervous. Which brings us to the Fed's motive here. It really boils down to this. This was about prevention, not profit. They weren't trying to make anybody rich. They were trying to stop a liquidity crunch, a scenario where banks might literally run short of cash. That could force them to start selling off assets, which could trigger a full-blown panic. So this was a defensive play, plain and simple. So what you're seeing is this incredibly delicate balancing act. The Fed is desperately trying to keep the financial plumbing from seizing up, while at the same time they're trying to fight inflation. They've made the system safer, for sure, but this is a sign of stress under the surface. It's not a signal for the markets to go wild. And that stress, it doesn't just stay at the top. It always trickles down. And all that abstract financial stuff, it doesn't just stay in those marble buildings in DC. It hits the real economy hard. You can see it perfectly in an industry like equipment finance. We're talking about the companies that lease and finance everything from huge construction cranes to MRI machines. Their entire business depends on a stable, predictable financial system. Now, on the surface, everything looks great. Their big conference theme for 2025 was From Seed to Success. It's all about growth and opportunity. And that's pretty normal, right? It's the kind of public-facing confidence that every industry tries to project, even when things are a little shaky behind the scenes. Because beneath that rosy picture, this is the reality. These are the headwinds they are sailing right into. Things like rising inflation, volatile interest rates. Those are direct consequences of that stressed-out economy we were just talking about. And this just shows how even industries that look totally solid are dealing with the exact same cracks in the system. Oh, and pay close attention to that last one. AI-driven disruption. That's a crack in a whole different kind of system, and it is about to take center stage. Okay, so we've gone from the trillion-dollar decisions at the Fed, past the billion-dollar industries, and now we're zooming all the way in, down to the individual. We're talking about the bloggers, the independent journalists, the creators who built entire businesses on a system they thought they understood, Google search and advertising. Just read that. Let it sink in. Imagine spending years building your business, having a steady, predictable income, and then one morning you wake up and 93% of it is just gone. This isn't some slow decline. This is a catastrophic system failure, and it's happening at the most personal level imaginable. So how did this happen? Well, it was a terrifying 72-hour period back in January of 2026. Google's ad system basically broke. Publisher eCPMs, that's just the fancy term for how much they get paid for 1,000 ad views, they just fell off a cliff. For thousands and thousands of creators who rely on this money to live, this was an extinction-level event. But here's the thing. Even after that immediate crisis passed, a second, maybe even more permanent threat was growing. Google's new AI overviews. You've seen them. They answer your question right there on the search page, and they are devastating for website traffic. When that AI summary pops up, the number of people who actually click through to a real publisher's website gets cut nearly in half. The system isn't just broken anymore. Its fundamental rules are being rewritten in real time. And this chart just hammers home the built-in fragility of the whole creator economy. This shows the average RPM, which is what a publisher makes for every 1,000 visitors. I mean, look at that. The system was already deeply unequal. A publisher in a high-value niche like finance in the US could earn literally 100 times more than a creator in another part of the world for the exact same amount of traffic. For so many people, there was never any safety cushion to begin with.
So, what do you do? What do you do when the systems you count on, whether it's the global banking system or just the search engine, start to crack? Well, you're forced to adapt. You have to find a new way to survive. And we're seeing this happen at every single level of this story.
This table really ties it all together. At the macro level, you have the Fed responding to low reserves with a cash injection, a plumbing fix. At the industry level, you have equipment financiers responding to economic chaos by leaning into new tech. And at the micro level, you've got publishers responding to AI and ad failures by desperately diversifying their income. Do you see the pattern? Threat, followed by a forced response. And this right here, this is the playbook for that response. This is the survival guide that was born out of that publisher apocalypse. Build audiences that you actually own, like your own email list. Add multiple streams of income. And maybe the most critical point of all, reduce your dependency on any single platform. Don't ever let one company's glitch become your personal bankruptcy. And honestly, that isn't just a strategy for bloggers. That's a lesson in resilience for pretty much anyone in today's economy.
Which leaves us with this final thought. From the Federal Reserve trying to stabilize trillions of dollars, all the way down to a single creator trying to salvage a $35 day, everybody is just reacting to cracks in the system. And it really makes you wonder, in a world this interconnected, this fragile, are we all now responsible for building our own lifeboats?